Hello, good morning, and welcome to today's episode of True Potential's Morning Markets. You're joined by myself, Matt Henderson, and I'm one of the portfolio managers on the Growth Aligned fund range. So, if we think about two of the major talking points from markets yesterday, we had over in the US some of the inflation numbers, and over in Europe we had Christine Lagarde, who is the president of the European Central Bank, talk about their upcoming meetings and monetary policy. So, if we start in Europe with Christine Lagarde, she's come out and talked about it being weeks, is the direct quote, after the net bond purchasing program ends when they'll think about raising interest rates. Now that is a very significant development for Europe. It's the first time they would have raised interest rates since 2011, and we've got to remember that interest rates within Europe have been negative since 2014. So if we think about how the market's taken this and the pricing that we're seeing, we've got in for the July and September meetings 2 quarter point interest rate rises, and the market pricing sort of the terminal rate or the end point in interest rates hitting 1.5% in 2 years' time. So Europe now has a bit of wiggle room to increase interest rates. Now, if we turn and look at the other side of the world, over the United States, we've had the inflation reports come out, obviously a big topic at the minute, and we're gonna focus in on two of the major points. So CPI year on year, and then core CPI with the month on month number. So if we think about the core CPI year on year, number came in at 8.3, which positives and negatives to think about with that one. Positives in the fact that it came down from last month's reading of 8.5%, but still slightly above market expectations of 8.1%. However, when we think about the core number, core being stripping out food and energy as the more volatile components of that inflation basket, we've actually seen a pickup in the month-on-month number. So month-on-month number coming in at 0.6, last month's reading 0.3, but market expectation of 0.4. Now, if we think about some of the components within that basket that have moved, we've obviously had moves up and down. We think about energy and gasoline. We've had energy commodities down around about 5.5%, gasoline down 6%. So that highlights the differences between Europe and the US, with the US being more self-sufficient on its commodity production. And then if we think about the other side, things that have moved higher, and we're starting to see a bit more of a spread into other areas of the inflation basket. So we're seeing housing and shelter up 0.5%, food up 0.9%. But one of the very big moves is airline tickets up 18% on the month, which sort of demonstrates what we've talked about in terms of the rotation from goods into services in the US economy. Now, if we think about how markets reacted, if we take the 2-year US Treasury, why? Because it prices interest rate expectations more heavily than other bond maturities, and inflation obviously being key into what central banks think about monetary policy. We've seen when the numbers dropped at H1 yesterday, 2-year bond pushed out 10%, but in these videos we've talked about the theme of intraday market volatility, and that was key once again yesterday, with the 2-year bond falling by the end of the day, round tripped and ended about flat. Within equity markets, news was taken slightly more negative, with equity markets coming off and those growth themed stocks performing worse. And that's everything from me today. Thanks for joining us.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.